Good morning. My name is John Von Paris, and I'm the chairman of the MDTA Finance and Administration Committee. I hereby call the meeting of the Finance and Administration Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance and Administration Committee webpage. All members will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. I ask that those who are presenting or answering a question to please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. At this time, we will begin with agenda item number 1, approval of the July 10th open meeting minutes. Is there a motion?
So moved. Member Rosen.
Thank you. Thank you. Member Rosen, is there a second?
Member Ardinger, I'll second.
Okay, thank you, Member Ardinger. All those in favor?
Aye.
Aye.
Opposed? Motion carries. The minutes are approved. We will move on to item number 2, contract number KB 30230000R. That's maintenance and repair of Curtis Creek Drawbridge. And Abby, I believe, is here to present this morning. Or
yes, good morning.
Hi.
My name is Abby Tamrat from Office of Engineering and Construction. I'm presenting KB 3023-000R, maintenance and repair of Curtis Creek Drawbridge. This contract is funded. Good morning. This contract is funded 100% with toll revenue. The work to be performed under this contract is located in the Francis Scott Key Bridge. The purpose of this contract is to provide maintenance and repair contract for I-695 over Curtis Creek Bridge, both the drawbridges, the inner loop and outer loop. The scope of work includes providing general housekeeping maintenance of electrical, mechanical, and structural systems of the drawbridge. As part of the maintenance efforts, if the contractor finds any defects with the bridge or the machinery, we're planning to use this contract to repair it. Procurement method used is a typical low bid construction project. The allowance items in this contract include $100,000 for materials, $50,000 for specialized equipment, $50,000 for specialized subcontractors, and $100,000 for miscellaneous repairs. The engineer's estimate for this contract was $3,969,650. Advertised on March 25, 2025, bids received on June 17, 2025. The bids were received, 3 bids were received. The low bid was submitted by Florida Drawbridge, Inc. And the amount of $3,027,500. Second bidder was Chimbro for $3,299,150. Third bidder, Covington Machine and Welding, is $3,920,336. We are recommending award of this contract to Florida Drawbridges, or FDI. The low bid price was 24% below the engineer's estimate. There was no bid protest or rejection. Bid justification was prepared for this contract due to the price differences between the low bidder and the engineer's estimate. Overall MBE goal for this contract was 21%, with 8% African American and 11% women-owned businesses. The VSBE goal is on 1%. FDI MBE plan meets the contract goals and currently being evaluated by MDTA's Civil Rights and Fair Practice Office. FDI is a new contractor to MDTA. However, the company has extensive experience maintaining other states' movable bridges. FDI currently manages over 50 movable bridges across Florida, Delaware, New Jersey, and Maine. NTP is anticipated in January 2026, and the contract duration is 1,095 calendar days, or 3 years. We are seeking contingent recommended approval for this contract to take to the full MDTA board. With that, I conclude my presentation and open the floor for questions.
Okay. Abby, thank you.
Sure.
Very thorough. You were very thorough in that presentation. We appreciate that very much.
Thanks.
Member Ardinger?
Thank you. I just want to understand, so if there's going to be a review of the drawbridge, and if there is a repair needed, how does that fall under the contract and how does it fit into this price? Could you be a little bit more specific on that?
Yes, so this contract has on-call type labor and material items in it. So if they find some defect, we'll use that labor and material items to pay for it. So
And
the
if
way
they-
go ahead.
Okay, I'm sorry, go ahead. No, you go ahead.
So the way the contract is set up is they have a maintenance pay item for monthly, quarterly, and yearly maintenance of the bridge. We also have on-call type labor and material if they find something.
So the price that's given covers covers any type of needed repairs that would come up. However, what happens if the needed repairs falls under the dollar amount of what we're paying under this contract?
Under? Well, this is a follow-up to a current contract. We actually have identical contract ongoing right now. So whenever we find something, we use the on-call, and we haven't had any issues paying for it.
I guess my concern is more that we spend $3 million with the assumption that there's going to be some needed repairs, and the bridge is in better condition than we expect, and we never reach that $3 million number needed of repairs. Could that potentially happen?
No, the $3 million is mostly for maintenance of the machinery. You still have to maintain the bridge monthly, yearly, quarterly. So that's the cost. That's the majority of the cost of the contract. Whether we find new defects or not, the majority of the contract amount will be spent, because those machineries need really, I mean, the maintenance is intensive for drawbridges.
Okay.
Yes, so it's unlikely that we're gonna underspend the contract.
It's unlikely, okay.
Very unlikely.
But we could, on the other hand, we could overspend. They could find more repairs that are needed. And if that happens, we're still at that $3 million is still the cap.
Yes, unless the chief engineer approved extra.
Okay, all
Yeah.
right, all right, thank you.
Sure.
It's a very good question, and I wanted to just, you said it's unlikely, but that we would overspend or exhaust it. Is that what you're saying, Abby? So I guess,
Correct.
but say this does happen. Say we're $200,000 out there, and we did a lot. We spent a lot, but $200,000. What happens to that $200,000? I think that's the question. Is that the question that you want clarity on, member? Yeah.
Yeah.
And if we can't, I guess it's, you know, it's important, I think, for the approval process here to understand that, I think. I'm sorry. Jeff, did you want to say something too? Add in?
Yeah, I was waiting to see if Abby wanted to say anything.
Okay.
I think what we typically do with these contracts is we build out the scope of work of the contract. We build out the estimate of the planned work. So we have planned this number of labor hours, this amount of preventative maintenance over the period of the contract, and we've planned for it to cost the $3 million. But we're not paying for services that aren't rendered. So if certain man hours aren't expended, it's not a lump sum contract where they will get to collect the rest. There is an allowance that is not guaranteed, to be used, but that allowance is for those repairs that you're discussing. If we find we need to do something beyond preventative maintenance, we have the allowance, and the allowance is only spent with the project manager's approval, and we're only paying time and materials. It's not a profit driver for the vendor. It allows us to build in contingency when there's something we didn't plan for, then we can't, reasonably hold them responsible for. But that also will not be spent if it's not needed.
So I guess we also have pricing, labor rates and material rates that we would, they would apply to this, and then we have our own way of verifying that the work is done and the hours and auditing or whatever we need to verify that. Is that correct?
That's a big part, I think, of what Abby's team would be doing, is verifying those hours and those invoices.
Okay.
Yeah, we
Member
do
Arden?
that.
Yeah.
We do that in collaboration with construction inspection team.
Okay. All right. Member Ardinger, are you comfortable with the answers?
I am. Thank you to all for
Okay.
clarifying that.
Right. Abby, thank you. And
You're welcome.
Jeff, thank you for chiming in there. Thank you very much. Okay. Is there a motion to advance this item to the full board for approval?
Member Ardinger also move.
Okay. Is there a second?
I'll second. I think Member Carroll has an issue with it. I'm reading his lips. I think he's second.
Okay. Member Carroll, you okay? Okay. Yeah, we cannot hear you.
Member Carroll, though, right now, your mute just came off. Still can't
Yeah.
hear you. Yeah.
Well, okay. We'll call this, I guess, an affirmative. We'll vote on this. If that's acceptable. Okay, that'll be your, okay, up or down. All right, we have a motion and a second. Is there any further discussion? Okay, I don't see anything. All those in favor?
Aye.
Aye.
Opposed? Motion carries.
Thank you very
And,
much.
And thank you. Okay, so Member Carroll will still work on trying to communicate here. Okay. All righty, thank you. We'll move on to the next item, number 3. It's an approval item as well. Investment Committee report, quarterly update on the investment of MDTA's funds. Very important report here. Clayton, Kevin, and Alan will be the presenters on this matter. So good morning, gentlemen.
Good morning. I'll be kicking off with the agenda and key points. The team will be providing a market update. Then we're going to go over the portfolio composition of the investment portfolios and compliance. We'll discuss briefly total return performance. And then finally, we'll cover our strategy, and Alan will be asking for benchmark approval. There are a couple of key points. Firstly, that the diversified investment portfolio remains in compliance with the investment policy and trust agreements. MDTA's match funded accounts are still benefiting from higher prevailing rates for short-term instruments. We'll also be covering our total return, which most people think of as duration targeted, or some people say weighted average maturity, our investment strategy. The long-term reserve account strategies should remain consistent despite periods of short-term return volatility associated with various market events and with rising interest rate environments. There is also multi-year average returns for longer-term reserves align with financial forecasts and approximate the anticipated started rolling yields. I'll be turning this over to Clayton at this point.
Thank you, Kevin. If we'll move on to slide 3, we'll talk for a few seconds or a minute or two about the economy, the Fed, and the bond markets generally. On slide 3, you'll notice on the graph there at the bottom, The Fed's preferred measure of inflation, course PCE, remains more elevated than they would prefer at just under 3%. Although admittedly, it's being driven by services more than it is by goods lately. And so there is concern. This is stickier than they would prefer. They're happy with the employment numbers, but have decided to stand pat on any easing of interest rates, given these higher than desired levels of inflation. One big question for the Fed has been the tariffs, as you may have seen in the press. They remain concerned about the impact that tariffs will or may have on the economy. That's an ever-changing dynamic and may be impossible to price in, but they're hesitant to ease. That said, there has been some dissension on easing at the last meeting, where 2 members of the committee voted to loosen rates a little bit. Moving on to slide 4, we do show the GDP, inflation, and unemployment numbers. As I mentioned, the Fed remains content with the unemployment levels where they are, a little bit desirous to see the inflation numbers down some, and GDP is fairly consistent, if lower than they would like. We show the U.S. Treasury yields as well there on the graph. You'll notice that the measuring the yield curve on the 2, 5, and 10-year basis, the curve is normalized, where the 10-year yield, the green line is higher than the 2 and the 5. So we've seen that curve normalize over the past, year and a half. Moving on to slide 5, highlights the composition of the portfolios. This includes all monies, both the match funded as well as the total return that Kevin spoke to earlier. We have a significant allocation to the MLGIP, and a majority of this is funded by the Keybridge insurance proceeds. That's a very liquid, highly rated fund, so we're comfortable with that entire allocation in MLGIP. We also see over on the left allocations to munis and supranational agencies, and have a pretty opportunistic approach to the portfolio, the total return portfolios, that is. I'll highlight the munis a little bit later, but you'll notice that the municipal allocation is 133. As we think about other investments we have that are muni related, they're not necessarily categorized as munis because they are securities that are escrowed and hold treasuries. There's another 18 million in the muni category. So in total, we're at about 150 in muni related securities, 150 million. Moving on to slide 6 shows the maturity distribution for the assets of the agency, well over $1 billion. As you would expect, the match funded assets are the significant percentage and are very invested very short term, anticipating spending needs for capital, debt service, and operating cash. Slide 7 shows a breakdown for the maturity breakdown for the 2 total return accounts, those being the general and the M&O. You may recall the general account is allowed to invest out to 5 years, and then the M&O account is allowed permitted to invest out to 15 years per your authorization and approval. So that 5-year plus allocation consists entirely of M&O assets.
I'll be taking over from Clayton here. We're moving on to page 8, and we'll be covering the portfolio composition and compliance a little bit more depth. The portfolio has complied with all legal and policy limitations for the period March 31, 25 through June 30th, our fiscal year end. Investment holdings are all above the minimum credit rating set in the policy. Investment concentrations are below the required limits, and the portfolio has conformed to maturity limitations. This is covered on page 8, page 9. As Clayton has alluded to, we are heavily concentrated in the front end at this point for match funded, and that's the part of the portfolio that's benefiting from higher short-term prevailing rates at this point. You will see U.S. agencies in here. Over the course of a period of time, there's been a decline of issuance demand by the U.S. federal agencies, which is probably what's contributed to our looking more so at the municipal debt and finding some relative value in that sector of the portfolio. I'll be returning this back to Clayton to go over our dealer trade allocation.
So the dealer trade allocation table on page 10 is something we like to include every quarter for your review. We're obligated to, where possible, trade competitively. In other words, to have more than one broker dealer bid or try to offer securities to the agency or for the agency. This is not done all of the time. For example, when we're involved in the corporate or commercial paper market, we're typically dealing directly with the issuer, in this case being Toyota, or as you can see lower down in the table, ExxonMobil. Nothing to note here other than I like to point out the fact that you'll notice the sales near the bottom middle are almost $100 million for the 12-month period ending June, and the purchases are almost $400 million. What that implies is that there are a lot of maturities. A lot of the securities that we purchase end up maturing, and so we're not forced sellers. We let the paper naturally roll off and do not have to pay transaction costs. So the goal here is to manage and trade this portfolios very efficiently at a low cost. Moving on to slide 11, we show the portfolio composition just by total return and match funding assets. Again, the short-term assets are managed according to projected spending requirements, and that's the driver. We're not trying to play the curve or play rates or play changes, anticipate any moves in the market. We're simply matching spending, or if you will, asset liability matching. Slide 12 discusses the strategy, and I'll turn it over to Kevin for that.
Thank you, Clayton. It's important to note that the general and M&O reserve remain in compliance with board-approved strategy, approximating 100% of respective benchmark index durations. Of course, there's always going to be slight variations as securities roll down and start to mature, and we reposition to match the duration. If you look at the box on the top third of the page, you'll see the strategy for the prior quarter showed the general account, which is our shorter duration account, was 102% of the designated target. That's within the tolerance range. And the M&O reserve, which is the longer duration, is at the same rate, about 102%. In the current quarter, as the maturity did roll down, you'll see the shorter duration portfolio, which is the general portfolio, fell underneath the 100% mark, but was within the tolerance level. And the actual longer portfolio of M&O reserve ended up on top of the index at 100%. For the match funded account, the important thing about the returns is investment returns in the short-term portfolio are a function of prevailing interest rates for short-term investments, such as money market mutual funds, MLGIP, short-term agency, supranational discount notes, and commercial paper. The short-term rates have been higher than some of the long-term yields. In the total return accounts, longer duration indices benefit from higher average annual returns over multi-year periods, experience greater return volatility as you would expect longer duration associated with mark-to-market relative to shorter term duration indices. Clayton will be moving to slide 13.
Yeah, in slide 13, we talk about some of the relative value and benchmark implications for this. And I think Alan may want to weigh in if he's on the call and available. So I'll turn it over to him.
We had a question last quarterly board meeting, and I thought the relative value might be a good lead in helping to answer that question. We have two benchmark indices that own only treasuries and agencies, but from time to time we're adding other sectors to the portfolio, and those are considered spread sectors. The spread indicates additional yield, and so we're relatively passive when it comes to the index. We're not making rate bets, but we are active in security selection. And in a moment, Clayton's going to show an example of swapping from a treasury or agency into a taxable municipal bond for additional yield. But I think this is a good lead in. So on page 13, you can see the three spread sectors that we often buy. There's supranationals. Our target additional yield for supranationals is approximately 10 to 15 basis points. They've tended to trade relatively close in yield to treasuries and agencies in recent years. And so that's when you saw the pie chart. We have a relatively small allocation to supranationals, and it's just because on a relative value basis, they're not super attractive right now. Municipal bonds, we do have a larger allocation to. They tend to historically present significant relative value to treasuries and agencies. And so we're constantly looking for comparable maturity duration, AAA and AA rated municipal bonds with yields of 20 basis points more than a comparable maturity treasury or agency. And I think, Clayton alluded to a defeased muni in the compliance report where we count those as treasuries or agencies. A defeased muni is when a municipal issuer tends to refinance their debt. They may not have the ability to call it away yet, and so they set up an escrow account. They issue new bonds to pay off the old bonds, but they have to put the money in an escrow, and typically they're buying U.S. treasuries or U.S. agencies and putting them in that escrow. And so when we buy a defeased muni, it's essentially backed by that escrow and no longer backed by the issuer. So at times we'll buy a muni bond that's actually backed by treasury securities. And then the last sector is commercial paper. That's typically held only in the shorter term accounts like the capital account, but we're looking for spreads over money market mutual funds, typically 10 basis points or more before we would buy those. So moving on to slide 14, the question that was raised last quarter at the board level was, what was the interest rate outlook for the investment committee? And I think maybe a better way to answer it was that, we have several statements throughout our presentation that address that. Is that, one is that management does not attempt to time market rate changes. We've picked a duration target that's been approved by the board for those two longer term reserves. And those longer term duration targets, they help exploit the term structure of interest rates. So longer maturities offer higher yields, and though that exposes the portfolio to more price volatility and more return volatility, and it's expected to add to returns over multi-year periods. So we're not making rate bets. We're not trying to call or time the market, and that's characterized as a passive approach with regard to duration. Where we are active is in security selection. So we can add value through an active approach to security selection. And that's not only when where we have a maturity and we can reinvest or new money flowing in, but also we constantly look at the portfolio and look for what we would characterize as a duration neutral swap. So we're not taking additional rate risk or taking additional credit risk. We're swapping from something of similar credit risk and similar duration into something that just yields more. So in the case of a taxable muni swap, we might be swapping out of a US Treasury and into a taxable muni that offers, more yield, but no significantly greater credit risk and no change in the duration of the portfolio or rate risk. And so with that introduction, I wanted to turn it over to Clayton, and he'll explain a recent relative value swap.
Thank you. So on slide 15, what we've done is put together a chart that shows, where AAA and AA muni bonds have been priced relative to treasuries, and the orange and the green lines above the blue line being the treasury, the orange and the green being the munis, indicate that munis are cheap, oddly, for those not in the fixed income markets daily, indicate those are cheap relative to treasuries. And we also display that in the bar chart down at the bottom. And you'll notice that the orange bars are generally lower than the green bars, for one. And that as you go out the tenor or the time horizon, the differences between treasuries and munis gets bigger. And so given our kind of internal constraint that Alan referred to earlier of 20 basis points, we generally tend to look at opportunities 3 years and out. So moving on to slide 16, we had an opportunity, broker called up and mentioned there was a defeased muni backed by treasuries trading at around 25 basis points over treasuries. And so we looked at the documentation, we reviewed it, and agreed to go ahead and transact at 26 basis points over. So our goal is 20, but oftentimes we're able to take advantage of these opportunities at 25 or even more, 40 or 50 basis points, depending on how far out we go and what's going on in the market over treasuries. And so if you take our $150 million allocation to municipal bonds and you multiply that by 20 basis points, well, that's some real value. That's about $300,000. So if we can generate an additional $300,000 a year, we see that as being a really good thing. In this particular instance, we own the treasury there at the top in the table. We own the treasury, and this treasury had a duration of 2.25 years, just over 2.25 years. We took the opportunity not only to take advantage of the muni value, but also to extend the duration a little bit. So you'll notice that the purchase, the California CAS, had a duration a bit longer than 2.25 years. So we're often able to generate some additional yield as well as manage the duration of the portfolio. Kevin referred to the duration of the portfolio in one of the slides he covered, where at the beginning of the quarter, the account was 102% of the index. Moving on to slide 17, if there are no questions, we covered the performance. The last 12 months on the far right is what we tend to focus on. There can be noise inside of 12 months, 1, 3, and 6, but we still think it's responsible to show these returns. But over the 12-month period, the general and the MNO accounts have modestly outperformed their indices. So we're pleased with that. Again, there can be some shorter term volatility, and we expect that, and hopefully we've advised you properly to expect that, and there's no surprise here. With that, I'll turn it back over to Alan unless he'd like to add something.
So our conclusion is always that we typically, I think, and this is in line with not trying to time the market, as we maintain a consistent duration approach, and we tend to not recommend new or different indices. So the investment committee is requesting that approval of the finance committee and concurrence with these existing benchmarks and strategy to move forward to the full board for approval of continuation of these strategies and benchmarks. So I would open it up to questions as well.
Are there any questions from the members? I guess I'm looking for Member Carroll, but I guess we couldn't reconnect with him.
I'm here, John. Can you hear me now?
Oh, great. Okay, there you are. Hi. Okay, good. Good to see you. Good to hear you. Any other comments or questions? Okay, let's see. Is there a motion to advance this? I guess I want to say this to the presenters, Alan, Clayton, Kevin. You know, you do a great job with this, the work, and then you do a great job in presenting this to us. It's a lot of work behind the scenes. I think we recognize that, and we appreciate the good work that you're doing. So anyway,
Thank you.
Thank you. I don't see any questions. Is there a motion to advance this item to the full board for consideration?
So moved, Member Carroll.
Thank you, Member Carroll. Is there a second?
Second, Member Rosen.
Thank you, Member Rosen. Is there any further discussion? Okay, all those in favor?
Aye.
Aye.
Opposed?
Aye.
Motion carries. Thank you all very much for your presentation. And we will move on to the next item. And that will be, let's see here, item number 4. The investment policy. And Clayton and Kevin will stay on and present. Good morning
Thank
again.
you. Hi. Consistent with our annual requirement and review, we would like to present members of the committee with a few changes to the investment policy. We see none of these changes or revisions as being material. Hopefully you will as well. But as part of a living, breathing document, we think it's necessary to amend and revise and clean at times. And so the memo at the summary portion talks about the 4 changes that we're proposing. The first being, maybe the memo is the easiest way to review this, but we've also attached the actual policy itself, a red line version. And so I'll probably try to skip through this. On page 3 of the policy, we talk about allowable investments. And so the proposal here is to delete specifically named agencies. Doing our research for this annual review, we found that some of the agencies just are not active in the market. We don't see them on an ongoing basis issuing or trading in these securities if they have issued. To the extent that we do see something, it's generally not terribly liquid. We're always trying to be cognizant of holding to maturity, but we recognize at times that we may need to sell. So something may be attractive, but if it doesn't appear to be liquid, we're probably not going to be very interested. And then finally, 1 or 2 of these agencies no longer even exists. So page 3 of the policy proposes striking, I think it's 6 of those named agencies. Actually 7. So that's the first proposal. The second item we would propose is elimination of what are referred to as bankers' acceptances. These have historically been a very active part of the fixed income markets, going back even to the 80s and 90s. This was a very large part of the market. We have watched this for some time now and have not seen any activity in this area. And so propose to you to strike this as an eligible investment in the policy. Doing some research for this, I spoke to a couple of brokers, and one of the broker mentioned that he hadn't seen bankers' acceptances trade for over 15 years. So that's just not a part of the market that's of interest, and it's basically non-existent, and so we don't need that opportunity if it doesn't exist. So that's the second proposal. The third proposal under allowable investments is basically meant to be more in line with what's in the state treasurer's policy, the investment policy for the state of Maryland. That's on the bottom of page 5 of the policy. So we typically have in that section named specific supranational issuers. The state, again, trying to be more in line with their policy. The state names a few, but they also mention that we're not limiting to investment to those that are named, but there is a broader opportunity set out there, and they are allowed, and we're asking your approval to allow a more permissive or broader opportunity set. You know, one I can think of, or two I can think of that aren't named here would be, for example, International Monetary Fund or the European Investment Bank, even the European Bank for Reconstruction and Development. And these are institutions that are actually AAA rated, higher rated than the US even, and that are typically pretty active and liquid participants in the market. So we would ask to broaden the language a bit there. Obviously, we have the rating constraints, so we would abide by those as well. And then finally, under the fourth proposed change, we would ask your approval to delete the operating reserve account reference under section 6, and that is on page, sorry, let me scroll down here. That is on page 6. So the operating reserve is no longer an account that's used or open. Alan, if you'd like to add some context to that, please feel free, but we no longer need that reference in the policy.
Just mention some of the history, and just to allay any concerns, is that we had for many years an operating reserve that had never been utilized. When I came to the agency in 2007, the reserve had never been used in 25 years. What we did some years ago with board approval was consolidate that account with the general account. And so that essentially saved us from having two accounts to account for. So no more bank reconciliations for that account. On the investment side, we didn't have to invest money in the operating reserve and the general account. They just were consolidated. So that just saved time. So never, rather than Clayton having to buy something for two accounts, he just bought a larger piece for one account. So if the account doesn't exist, then there's really no reason to name it in the policy, and it would be confusing to somebody coming, years from now, and they would wonder what the account was and why aren't we funding it, and is it necessary? If you recall, the $400 million that we have in unrestricted cash is really driven by a need to have a liquidity, and the rating agencies expect toll revenue sector issuers to have unrestricted cash reserve that approximates your annual operating budget. And so periodically we come back to the board and make recommendations for increasing that reserve. And that's why it's sized at approximately $400 million. It's solely held in the M&O reserve and the general account. So effectively, we just went from 3 accounts holding this money to 2 accounts. And so I don't anticipate that we would ever reopen that operating reserve. And so I think it's just confusing to have it named in the policy. The general account essentially can function, as the same as an operating reserve.
And then finally, we should just highlight for you, and on page 7, under diversification, you may have noticed that we deleted reference to bankers' acceptances there as well. And so if we're proposing deleting them from the eligible investments, we should also, as a matter of course, delete them from the diversification limits. So with that, thank you for your time. Are there any questions?
I don't see any. I do have, I guess, just a comment I have. This is a cleaning up of the policy, the document, a lot of it, and then of course, as you mentioned, the closer alignment with the state. Is that right? You said that, I believe, with some of the
correct
policies.
Yes. Yep.
And the question is, I do have a question along with my comments, and that is, how often do we like, if we see things that need to be addressed, we stack them up unless it's something urgent, right? And then we deal with it. But how do you see something? It's more frequent than it's been in the past. The catching up or the cleaning up of the document, and what does that process look like? I'm just curious.
Yeah, I'll just refer you to the last page of the policy. If you don't have it, then you'll notice that there have been years where we've come not on the annual review period date, and so we tend to, if we see something that's urgent, needs addressed, we'll bring it to you as required. And if not, then we'll stick to the normal routine and bring it to you on an annual basis.
Okay.
If that helps.
That
okay.
Satisfies my question. Thank you.
Okay.
Okay. Is there a motion to advance this item to the full board for approval?
Member Ardinger also move.
Thank you, Member Ardinger. Is there a second?
I'll second, Member Carroll.
Thank you, Member Carroll. Is there any further discussion? All those in favor?
Aye.
Aye.
Opposed? This motion is carried. Thank you.
Thank you
all.
Thank you.
Okay. We will move on to the last item on the agenda. It's an update from our executive director, Bruce Gardner. And it's going to be about the Key Bridge authorizations, expenditures, and reimbursements. Good morning, Bruce.
Good morning, Mr. Chairman, members. Yes, this is our first update of our different categories of authorizations, expenditures, and reimbursements. As the chairman indicated, this is brought to you at the request of several of you who wanted to get an update on this matter, so we can do this quarterly or as requested. But we want to go through the authorized amounts that you've done, the categories of spend, and these different funding categories, a little bit of briefing on that as we go through that. So the chart on page 2 shows the category of expenditures that have been approved. There are 4 items that are amount to about 171 million, and then that larger one that was approved in May by the board was the early works packages for 250 million for a total of 421 million. Those early works packages, as you may recall, include things like long lead items, early construction, and miscellaneous support such as leases or other materials testing that are needed. The second table goes through the expenditures. So we've expended around 77.4 million on salvage operations, progressive design build contractor, spending of about 58 million, and then support from our other consultants on the project for about 12.3 million, for a total of just under 148 million. On page 3, just summarize the quick release spending. The 20.7 million has been received based on invoices. Another 33.3 million in invoicing is under review for hopeful repayment shortly. So in addition to those categories of federal funding, we also have the insurance and that has gone towards salvage and some of the recycling revenues. So just wanted to summarize all those for you here. I do want to thank Betty Connors and Chantel for tracking this information, putting together. It is not an easy task. Breaking it down into the different federal categories, making it more meaningful for us. If we need to do some tweaks to this in the future for your understanding, we can do that. But do appreciate Betty's efforts. She was involved in the SHA federal funding for so long that some of this Greek to me has been translated nicely by her for me. So with that, we're available for any questions. Member Archer.
Hi. Thank you, Bruce, for this update. Great, definitely appreciated. On the federal funds, I'm sorry, let me make sure I get the quick release emergency relief funds that we have to apply for and then we get reimbursed. Are we expending the money first and then we have to, I'm assuming there's a delay?
Yes, yeah. We spend the money first. It goes through a pretty arduous process to make sure everything is eligible and in the right format. And then it's also a matter of making sure SHA is able to align their different funding authorizations so that when the invoices and the bills hit, they're all paid from the right accounts at SHA. So sometimes there's that delay of aligning things and making sure they're able to get things into the right categories before where the invoices can be approved, even though all the charges are validated in that process.
And what's the average time gap between us expending and finally getting reimbursed?
Well, it's gonna be different. I mean, with the QR quick release, there's a lot of learning curve in the beginning. So if I were to give you an average now, we're gonna hopefully do better in the future. I'd say the insurance proceeds that we're spending down, that the rest of the 360 million, that's going to be the next category that we'll hit between now and probably the end of November. So that still has a process too. So we're getting better. I don't have a kind of an average for you at this point. Betty, maybe that's something we can look at for the next update.
All right, thank you.
Good question, as usual, Member Ardinger, and I think you talked about this way back in terms of cash flow and the awareness and so forth, and big project. I believe the 25 million was earmarked for debris and salvage of the policy. I believe
Correct.
That is
yes.
Okay.
Yep.
But I guess the money comes from the federal highway to the state highway, and then there's a review, and then it comes to us eventually, right?
I mean, as Alan and the team indicated, the money for the insurance is really in our accounts. We've invested that. We have that. It's getting the approval to use that for the Key Bridge, and that it's all kind of the federal, because has to be spent in a federally eligible way. Some of the items can be spent for ineligible activities, but we'll have to identify that. Had to meet a certain obligation for them.
Thank you. Are there any other questions? Okay, Bruce, thank you very much for the update, and thank you to the members who requested this. Very much appreciate that. Okay, well, we have covered everything on the agenda today. So thank you everyone for participating, being here, and all the work to prepare for this meeting. Is there a motion to adjourn?
So moved. Member Rosen?
Thank you, Member Rosen. Is there a second?
Second, Member Carroll.
Thank you, Member Carroll. All those in favor?
Aye.
Opposed? Motion carries. We stand adjourned. Thank you all very much.
Thank you.
Have a good day.
Have a great day, everyone.
Bye, everybody.